Holly Black asks professional investors where they will be putting their money in 2018 and the areas they are avoiding. I will be keeping a close eye on retail prices next year. If inflation, which reached a 5-year high in October, continues to climb, then the stock market could fall. The price is already up 15% over the past year at $62 a barrel.I also like investment funds which own infrastructure assets such as schools, hospitals and prisons. As a result, they can deliver a reliable income stream to investors.A, particular like as John Laing Infrastructure, which owns assets such as service stations and streetlights. The fund would have turned £10,000 into £11,630 over the past 3 years. Any area I am staying clear of is high-yield bonds, issued by companies which do not always have perfect credit ratings. For brave investors, I like Jupiter India Fund, which invests in some of India's strongest companies, the likes of State Bank of India, tobacco firm Godfrey, Phillips India and Hindustan Petroleum. The fund would have turned £10,000 into £17,340 over the past 3 years. I am also keen on investment funds which back some of the technology stars of tomorrow. Liontrust UK smaller companies is a case in point. It has around a third of its money in technology companies such as software company Craneware. The fund would have turned £10,000 into £17,980 over the past 3 years. I am avoiding Bitcoin and other cryptocurrencies which I see as ad punts rather than investments. Next year I am shunning the US because company share prices look expensive. Instead I am looking to Europe. The political situation across Europe is relatively stable and the economy looks okay too. It seems as though the fog is clearing. A fund best placed to take advantage of this is BlackRock European Dynamic. The investment team is also well-resourced with a strong track record. The fund would have turned £10,000 into £16,530 over the past 3 years. I am also positive about Asia and like investment fund steward investors Asia Pacific leaders. The fund would have turned £10,000 into £13,700 over the past 3 years. Only area I am avoiding is government bonds and gilts. Historically, they have been a safe, lower-risk place to invest for a steady income, but with interest rates at rock bottom, it now effectively costs investors to lend their money to government because the interest rate the bonds pay does not beat inflation. I like Evenload Income Fund, which invests in dividend-paying businesses and would have turned £10,000 into £14,530 over the past 3 years. If there is a dip in the stock market, this fund is adept at buying shares which are out of favor. Recent examples include investing in finance group St. James Place when it took a tumble after the Brexit vote, and snapping up shares in luxury brand Burberry when it was having a difficult time. It would have turned £10,000 into £13,340 over the past 3 years. I will be avoiding the so-called FAANG companies, Facebook, Amazon, Netflix, and Google, whose share prices I believe are far too expensive.